Kim, just to be clear, I do the analysis. I have a view. I look hard at the data. I have models, so I exercise a lot of care on this. But I don't just ignore the alternatives. Sometimes you're wrong. You have to pivot. So yeah, we should all be watching for signs of inflation. I don't see them. I see disinflation, which means you still have inflation, but it's at a much lower rate. But there's a world of difference between, let's say, 1.8% inflation and 6.8% inflation. Those are completely different worlds, because one is much more manageable, but it also changes expectations. And expectations are the key. The Fed doesn't control inflation. Everyone's like, oh, they print money, you get inflation. That is not true. It's not true in prices. It might be true in asset prices. It might be true in stocks and bonds and real estate, but that's not the consumer price index. That's not what the Fed looks at. That's not what most economists or many economists mean when they say inflation. They're asset bubbles. Money printing can lead to asset bubbles, but it does not lead to price inflation unless velocity picks up. Velocity is a psychological phenomenon. So if you change the expectations and change the change the psychology, and change the velocity, yeah, you will get inflation, but I don't see any of those things changing. What I see is this runs out of steam and we get back down to below 2%. Inflation, disinflation, really important distinction. Of course, you can't say there's no inflation. There is inflation. I always say, you're entitled to your opinions and your analysis. You're not entitled to your own data. The data is what it is. And inflation has been running hot since last spring, since April, May of 2021. And some of the monthly numbers have come in, whether it's the producer price index, PPI or CPI. They're printing numbers at the highest in 30 years or sometimes longer. So we're going back to, if not the worst of the 70s, at least the early 1980s, but in some cases longer for these inflation numbers. So inflation is showing up. So that's undeniable. You can argue about the forecast, but it's here. When it first turned up in kind of April, May, June, even July 2021, you could say, and there was good support for it, that a significant part of it were what are called base effects. And you have to know how they calculate inflation. How does the government do it? They look at the monthly data and they compare it to the same month the year before. So it's a year-over-year comparison, but only for 1 month. Then they take that number and they annualize it. So whatever it is, they times 12, there's a little more to the math, but basically they annualize that. And that's the number you read about in the headlines. Well, if you say, okay, April, May, June 2021 were hot. Well, what was going on in April, May, June of 2020? Because that was the comparison. Well, the economy has shut down. I mean, literally shut down. The worst collapse since 1946. And one of the worst in American history. So we didn't just have low inflation in 2020, we had deflation, prices were going down. So when you get to 2021, the year-over-year comparison, of course it was going to be up. Of course that was going to be more than usual. That was completely expected. So here we are early in 2022, and as of the most recent data, we don't have the December data yet, but we have November data and we have some other indicators, and it's still a little bit hot. So now we're at a point where you say, okay, is this real inflation? I would define real inflation not just as numbers, but is it persistent? Is it pervasive? Is it across the board? Is it feeding on itself? Is it raising expectations? That's something to worry about. Or are there some specific causes we can point to and say, yeah, okay, that's causing a little inflation, but it's going to go away. So that's the debate. It's the biggest debate in economics right now. I'll give you my view, but be clear that there are definitely two sides of the coin, no pun intended, but definitely two sides to the debate. And in particular, you say, okay, let's disaggregate a little bit. The other numbers have been hot, but what's driving it? Well, one of the number one things are energy prices. Well, okay, but what was Biden's energy policy from the day he was sworn in? He shut down the Keystone XL pipeline. He handicapped fracking in Texas and Pennsylvania and other states. He prohibited new oil and gas leases on federal lands. He limited offshore drilling. And he did a number of other things, all of which were designed to basically handicap the oil and natural gas industry. Well, that's part of the Green New Deal agenda, and then they're subsidizing, wind turbines and solar panels. So solar and wind have a place, but they're supplements, and they're not reliable. You can't power a grid on it. It's intermittent power. As the owner of a large solar field, I know one thing: it doesn't work at night. It just doesn't produce any electricity at night because the sun's down. And it doesn't work in cloudy weather. It doesn't work when it rains and snows. So that's why you have batteries. You really run the house on batteries, and you got to charge the batteries. We're shutting down uranium plants. We're shutting down nuclear plants. Forget coal. Coal is like the biggest pariah out there. Well, guess what? If you handicap oil and natural gas and you outlaw coal or make it not feasible, and you shut down your nuclear plants, and you're going to run on, hydro, solar, and wind turbines, your power grid is going to fail. You're going to have blackouts, which we are seeing in California. This whole thing doesn't work, but it does raise energy prices, and that's the point. That the demand for coal, by the way, is like close to an all-time high because we still have a lot of coal-fired plants, and I can't get anything else. Get me some coal. So that's one of the drivers. The other big driver are used car prices. Well, what's up with used car prices? Why are they going up so much? Well, the answer is you can't get a new car. It's a computer on four wheels. And if you can't get semiconductors, you can't make new cars. And if you can't get new cars, you got to buy used cars. And they're in short supply, so those prices are going up. So my point is, energy is real. You need it. I fill my tank just like everybody else. I'm not immune to this. Used cars. But when you have a couple of things like that are driving the whole CPI, you have to step back and say, wait a second. Is this widespread inflation? Are expectations changing? Is this sustainable? Or is this just a short-term spike in a couple of key indicators? And rental equivalent housing is another one. There's a housing shortage because, zoning requirements, and BlackRock's buying up all the houses, and there are other reasons for that. And so as I look at it, what I see is, the inflation numbers are up. There's no question about it. But this is not the kind of inflation we had in the 1970s. In the 70s, it was, you got a raise every 2 years. I was kind of starting my career, and we get 3 or 4 raises a year just to keep up with inflation. It was like, okay, thanks for the raise, but, prices just went up 13%, which they were at the time. This is not that kind of inflation. In the 70s, it was everything. It changed expectations. It was what's called cost push inflation, which is workers are like, well, you got to give me a raise. And unions were stronger, but even non-union companies said, yeah, I do, actually. That's not true today. Workers don't have the bargaining power. Labor force participation is low. And like I said, it looks like a couple factors that are going to run out of steam, and the economy is slowing, and then we kind of can get into the whole supply chain debate. So just to sum up, I would look for disinflation. I'm not calling for deflation. Deflation is when prices go down. I can't rule that out, but I don't see that. That's not my, intermediate term forecast. But disinflation is. I see these numbers going down from, 6%, 7% annualized, which is what the government's showing, getting down to the 4% level and eventually down to the 2% level, which is where it was from 2009 to 2019 during that 10-year expansion.